bear market rally? Or is it, as Ben Amons from New Edge Wealth says, actually signs of a pent-up rotation? We find the next catalyst and then markets move higher and broaden out. And of course that brings us to the question of the day, Alex. Is the bullfight still on? Let's bring in Bloomberg's Simon White here in the London studio and Liz McCormick. And Simon, you bring the silver lining to the recession fears, and you make the case in the MLive blog this morning that maybe we are over-focused on recession squeeze on equities, that this time it could be different.
Yeah, I mean, it's been very tricky to try and navigate this cycle. You know, it's been very obvious to come up with the reasons why the equity market should be lower, yet it's just kept going higher and higher. And so you have to start wondering if you're missing something. And there's some very long-term signals are very constructive price action are pointing to much better equity behavior. So you look at, for instance, this massive rally we're seeing in the mega caps. You might think that that might lead to, you know, very narrow breadth as a bad sign. You actually go back and look at, say, the top 5 stocks, how they perform over time. They're actually still very oversold. They're just bouncing back into sort of mean territory. So they could keep on going. So it's very, you know, difficult to say this because we know these stocks are very overbought. If you look at traditional things like RSIs and stochastics, but on the other hand, you take a step back and for a typical bear market, they're actually underperforming.
All right, we have some breaking news. First of all, Simon, I feel like that's a little optimistic for you, but we're going to get back to that in a second. We have some breaking news, of which I know very little about, but I'm going to try. So we're looking at the PGA Tour and DB World Tour and the PIF are announcing a newly formed entity. PIF is going to make a capital investment into this new entity. LIV Golf, remember, was started by Saudi backers to try and take down the PGA. They got a lot of players to come over and play. Those players got in big trouble with the PGA. There was some serious money on the line. Apparently now the PGA Tour, DP World Tour, and PIF announced a newly formed entity. We will update you on any more headlines as they cross. All right, Liz, over to you. You want to answer the question? Is the bullfight still on?
Well, I think like Simon was getting to, like if you look at the macro side, this imminent recession, you know, the year started, it was like recession's around the corner. It keeps getting pushed back. In fact, Goldman Sachs team today, Jans Hatzius has put out a note, and they cut their outlook down to 25% odds of a U.S. recession over the next 12 months. They had kind of bumped it to 35 when the SVB collapse happened, and now like we got through the debt ceiling debacle without a debacle, and we got a deal that had less spending cuts than some thought, and the banking sector issues, you know, we don't know what's going to happen, but have kind of stabilized. So if you don't have a recession, you know, that's a 1 in 4 chance over the next year, then, you know, it seems like stocks, you know, can keep kind of going on for now, because I think what's happening too is to the non-stock folks, it's like, oh my God, what did I do? I missed the run, you know? It's like the fear of missing out is coming in. People who had cash in these high-yielding money market accounts are starting to pull it out, and I think that's adding to the momentum. But like I said, there's many saying the doom is coming, but it just hasn't come yet.
So Simon, FOMO maybe is a bit of a catalyst as well, or at least some of that money flowing in, as Liz was describing. What is the next step that you're looking for in terms of getting conviction around the broadening out of that rally?
Well, yeah, you would like to see it begin to broaden out, but historically that seems to be what happens. You know, at this stage in a bear market, you have the largest stocks are underperforming, but they're beginning to outperform, and then around about now you get the rest of the stocks beginning to catch up. So around about now you would normally begin to see that, but the recession thing, I think, is becoming a bit of a distraction because, you know, normally people think recession is, you know, bad for equities, but perhaps, you know, you have to have two contradicting thoughts to keep them in your head at the same time. That maybe a recession is not going to be quite what it once was for a stock market. Actually, I think the biggest risk, and this is not going to happen over the next 3 to 6 months, I think, is inflation making a resurgence. So that's allowing stock market to basically, you know, recover. We're seeing things return back to normal, vaguely, but, you know, while inflation remains kind of on the low side, that's fine, but if it and when it starts to pick up, and that really is dependent on China, I think that's the main risk that stocks face, not recession.
So the joke here, Tom, is that whenever Simon comes on, he's like the doom and gloom guy. So the fact that like there's like a temperate doom and gloom feels like a really big change. I'm just putting that out there, Tom.
I know, Simon's bringing the optimism
I mean,
today.
like, I mean, you know.
Pretty convincing from a Scotsman. That's impressive. I speak, of course, with Scottish heritage. Liz, in terms of what you think around the central bank overlay to this, and the RBA was a reminder that central banks aren't going to sit back. You know, arguably the RBA paused too early. You get a pause in June, and then you get a hike in July. They skip the Fed. How are you layering that on, that expectation? Or is the fact that it's becoming quite predictable now, is that what's capping volatility?
Well, yeah, volatility, especially on the equity side, just keeps going down, and they seem more sanguine there. I don't know, it seems like the consensus is Fed skips, not a pause, in June, and then comes back in July and does 25 bips. I don't think a lot of people are saying that's the peak. Of course, we have to see how things pan out, but I think the market is learning how to digest that, right? It's been a while, 500 basis points over the last a little over a year from the Fed, and I think Simon's point, and I'm also going to buy stocks since Simon is somewhat positive. I know him too. But I think he's right that, that the rates, holding up is not going to maybe kill the market. We don't have an earnings recession yet. And I think the other thing is that I think it might be different. You are hearing people say this time could be different, that, we might be able to go along further. And if the Fed just kind of hums along and it's a slow and variable lag, right? So things are going to get worse. But I just don't think you can write off that you might get through the end of the year and this stock market implosion that we thought maybe hasn't happened. It might come next year, but it's kind of slow to kind of come to fruition, right?
Right. I feel like we just kept pushing it out. I feel like we're having this exact conversation a year ago, which is what's kind of crazy about it. So, Simon, to you, what would make, though, the bull market more sustainable and not like, okay, I feel okay now, and then I'll hold on to this doom and gloom or recession worries for 6 months?
Yeah, normal service will be resumed, by the way, on the doom and gloom. It's just a temporary blip. But I think things are great right now in terms of the stock market can keep on rallying because the conditions are such that it goes along with it. And as I say, you just look at the price action, that's what it's telling you. The beauty of price action, by the way, is that it's not encumbered by any other biases or anything else like that. So I think that's why you have to pay attention to and listen to it. But I think 3, 4, 5 months time down the line, things could start to look quite different. And then I think, you enjoy this kind of will it last? But I don't think it's going to be something that's going to be persistent. And I'm not ready yet to say this is the beginning of a new bull market.
Okay, there's the caution to the optimism. Simon White, always excellent. Thank you very much indeed. And Liz McCormick, of course, as well. Now, joining us for more on those headlines on the PGA Tour, DP World Tour and Live Golf merger is Bloomberg's Scarlett Fu. And Alex, you're going to bring in Scarlett, and we're going to get more on this, what seems like pretty significant news in the world of golf.
I am. Yeah. I'm going to bring you in, I guess. Okay. Why is this so important?
Because it's the end of the Civil War in golf. There was this division between Live Golf and PGA Tour. It was certainly a threat, an existential threat to the PGA Tour, and this was something where the PGA they were filing lawsuits against each other, and the PGA basically essentially banned its players from participating in Live Golf, saying that if you go on their tour, you're not allowed to come back with us. So this changes the whole game completely because they're going in different directions, and it forced, in many ways, golf fans to make a decision which to follow, and golf players certainly to decide, do you go with Live Golf or do you stay with the PGA Tour? So to me, this is huge.
Yeah. It is undoubtedly huge. How did they, given that it was so heated, wasn't it, that competition, and the scandal and the controversy, at least, around players opting for the huge money tickets being dangled by the Saudis. How did we get to this point, Scarlett?
Well, Saudi Arabia's sovereign wealth fund invested in Live Golf, and there are a lot of accusations of greenwashing, sport washing, where it was trying to clean up its reputation with all the human rights abuses through sport, through golf specifically. And a lot of the players did like the fact that they would get paid to play and to participate in this league. So a lot of the players were put in a position where they were saying, do I stick with what's been traditional, or do I go with this new league that could offer better compensation? And there was a lot of controversy. Greg Norman was at the front of it, recruiting a lot of the golf players. And as time went by, you could see during the press conferences when the golf players themselves were talking about what they were going to participate in, there were a lot of testy questions. And it got to this cultural story that really took over the story of golf. And the PGA was really in a very defensive position and in a defensive crouch as a result. It wasn't clear how they were going to both move forward in parallel directions, especially because Live Golf didn't really have a broadcast rights deal, which I think is one of the big issues when you're talking about live sports.
Also, this was like billions and billions of dollars, some of these players, right?
Yes.
Like, it was serious cash. All right, Scar, thanks a lot. Really appreciate it. Bloomberg's Scarlett Fu. Okay, let's get back to the markets here. You're looking at the S&P now flat, like trying to be positive, but it's pretty flat. NASDAQ 100 is off by about 0.2%. You see a little sell-off in the bond market. We're kind of looking for the next catalyst. Yesterday, we did have a bull market in the S&P up 20% from the October low. Couldn't hold it. So let's get back to our question of the day. Is the bull fight still on? Joining us now for her take, Liz Young, SoFi Head of Investment Strategy. Liz, what say you?
Well, there's obviously still buyers out there. There's obviously still appetite for optimism and people who want to believe that this bullfight will continue to rage on. However, there are obviously risks in the market. There are risks in the economy. And there was a previous guest who said that this could go on for a while and the market still has room to the upside. I actually agree with that in the short term because there really isn't a catalyst, particularly this week. If we look really, really short term, there's not a catalyst that we know of on the horizon in the form of some big data release or earnings release that's going to come along and change our minds. And we do have the debt ceiling behind us, which I think the market was not really pricing in necessarily a resolution or an issue with, but the fact that we kind of got through it unscathed was another positive. So there's some optimism. I think there's a lot of tug and pull on whether or not we can make it above that August high of last year. And so far, we haven't been able to get there, but obviously people are hoping for it.
Liz, what are the technicals telling you about the next level that needs to be crossed to give this rally a little bit more sustenance?
Yeah, well, so this is kind of the big argument right now, right? You've got a lot of people saying this is still a bear market rally. You've got other people saying that this is the beginning of a new bull market. Here's the real answer to that. If you're looking at whether or not there's going to be a recession, and if we still think that there's going to be a recession at some point in the next, call it 12 months, which the odds would suggest that that is more likely than not, there's never been a time where the market bottoms before the recession begins. So if you're looking at it from a technicals perspective, have we actually bottomed? Was that true bottom in October? The only way that I would see that as a yes is if there isn't a recession. If there is a recession to come, we probably have more downside to go. What the technicals are telling us right now, particularly in the S&P, is that the index is above most of its moving averages, if not all of the ones that we would look at, so the 50-day, the 100-day, and the 200-day. That is a positive signal. But we haven't been able to really test and break through that August high from last year. And that's what people are watching as the next level of resistance. And if the market fails at that level or near it, that's where you start to wonder, maybe this isn't quite the bull market that we were expecting.
So, Tom, this also brings back something we were talking about yesterday, is the liquidity drain, right? We got, 130 or $170 billion worth of Treasury issuance. The takedown was pretty solid. And I also wonder, Tom, if you don't get a liquidity drain, does that weirdly provide more support then for the equity market? Like, it doesn't come from deposits. Like, it doesn't come from money markets, for example.
Well, yeah, and there's some estimates that liquidity drain could be equivalent to, about a 25 basis point rate hike, according, again, to some estimates. But if you see through this, and if markets see through this, and you continue to get that predictability, even if it means further hikes from the Fed, but it's becoming a fairly predictable pace, does that again cap volatility and lead to a little bit more support for this equity market? Liz, on the question of liquidity, is this a concern for you? And what parts of the markets would you be focused on to get a gauge and sense of that if it is a strain and stress in the system?
Is a strain and stress in the system. And obviously we saw the stress result in the regional banking crisis that happened in March and April of this year. But what's happening now is we've raised the debt ceiling. So there's going to be more Treasury issuance, and that has to be taken up by something. There has to be a buyer that takes that up, which will suck more liquidity out of the system. at the same time of quantitative tightening continuing to roll on. And then you've got this sort of underlying story, which doesn't necessarily make headlines or make it to Main Street, but the idea of small and mid-sized businesses reporting that it's harder to get credit today than it was a year ago. So there's not as much money flowing to businesses, which usually just kind of is a domino effect. If the businesses can't get the money that they need to finance their operations, they have to make cost cuts in other places, but that does take a while to actually feed through the system where we would see it. And regional banking crisis aside, even if things have calmed on that front, and even if we want to explain parts of it away and say that there were unique issues to certain companies, liquidity is a universal issue that every company will deal with if it gets tight enough, and consumers will deal with it as well.
Which then also just goes to show sort of the underperformance of the Russell, right? Like you definitely see that stress in the market of that thesis, which has led to this really weak breath, or the bad breath that we've sort of seen. And there is a debate among participants, like, is the bad breath like a harbinger of bad things to come, or can we still rotate within that limited breath?
Well, and that's probably the biggest argument that's out there. Will we see the rest of the market, the cyclical components, the average stock, the small caps, catch up to the large caps that have been leading, or do we need to see those big five names sort of fall off a little bit and meet somewhere in the middle? The divergence that's happening right now is not something that is going to last forever. And I actually think that the market is sending smarter signals than we're giving it credit for. When you look at what's been happening in cyclical sectors and what's been happening in small caps, there's obviously still some concern about economic activity. So the enthusiasm that we're seeing in some of those big names isn't necessarily spreading out. And the best analogy that I can make of it is, if you think about a sports team and you've got a star player, that one star player comes off the court. If it's basketball, you better hope that the other four can make up for it. And that's sort of what we're looking at right now. Can the rest of the index start to carry its weight so that we see this strength broaden out? And I'm just not so sure that that's going to be the case.
Making a sports reference to me. Liz, do not know me, but at all. All right, Liz, thanks a lot. I appreciate it. Liz Young, SoFi Head of Investment Strategy. All right, it is 25 past 7 on the West Coast. We do want to get to the startup where we cover those top tech stories from the Bay Area and beyond. Silicon Valley starts this morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, you just crushed it at the Apple event yesterday, but today the story is Sequoia Capital kind of separating its China, India, and U.S. businesses. Can you just talk me through the why behind that?
Yeah, look, Sequoia becomes three distinct firms, right? Sequoia Capital here, which will focus on the US and Europe, Hongshan, which is the English name the firms adopt in China, and then Peak 15 Partners, which is a reference to the original name of Mount Everest for its India and Southeast Asia Pacific investing arm. And the why is because they are already three largely independent firms. They operate in independent geographies, and what the partners of each regional unit said in the statement is that they're running decentralized organizations with a centralized back office, and it just isn't making any sense, particularly when you consider the competing policy standpoints of the United States and China right now, and the difficulty, not just the difficulty, but the debate around deploying US-originated capital into Chinese startups.
Yeah, and we know that Biden potentially is going to take some action on that front. Just Ed, on the China component, Hongshan, I think that if I look, I need to look at the characters, but I'm pretty sure Hong is red, Shan is mountain, Red Mountain, it seems maybe is what they can be calling. What in terms of the money that they put to play over the years, very early in terms of deploying capital historically, Sequoia, and they've done well.
And this goes to the core of the story. It's been a largely independent Chinese affiliate for more than a decade, getting in very early stage, deploying a lot of capital, but broadly across a portfolio. The more recent history has seen Sequoia China be involved in some very high-profile listings, ByteDance being one example. But again, remember the sort of ethical debate here in Silicon Valley. Should US domiciled venture firms taking money from US LPs be deploying that capital in China, either from a competitive perspective, from an IP perspective? AI has put that race and debate really in focus, along with our Bloomberg reporting that, according to sources, Joe Biden is looking very carefully at restricting outbound investment from the US to China.
Ed, I mean, you're in the Valley. Like, what does Silicon Valley think about that? Like, you have to have exposure to China in some capacity, right? So how do you do that? Like, how do you deploy capital, get good returns, but also not perpetuate technology growth or competition in China?
Well, look, every individual firm and every individual partner has a different viewpoint. Many that I speak to say we will not raise money from Chinese LPs and we will not deploy capital into Chinese startups because they believe philosophically that they should back the US horse in that race, be it AI or any other field of technology. And then consider our reporting about the policy perspective. Actually, it's becoming increasingly difficult to take US originated capital and deploy it into China. And many investors that I've interviewed or spoken to in the corridors in recent weeks would say, yeah, there's a clear backward-looking data tracker that shows VC investment in China is down, but also psychologically it's not a market that US VCs at least are racing to get into.
And I think you made a really, really interesting, fascinating point about AI, because if the US was not focused on restricting some of these fund flows before AI, then they certainly will be now because of that dual use. And you just think of companies like MEGV or SenseTime in China, which have been flagged as potentially being problematic. So just expand on that. It's the dual use component as well that's important in terms of national security for the US.
Yeah, so think about the restrictions the United States has made on the export of chip-making technology and the latest generation of chips. A concern around that is that it, in one instance, would power development of AI for use in national defense use cases by China. The other side of the debate that venture capitalists here in the Valley point out is that China has a real advantage when it comes to AI because they can dictate policy. They can basically provide the factors that will allow their entrepreneurs to succeed. If China wants to go big on AI, it will go big on AI. I'm paraphrasing, but it's the basic argument made by those VCs that recognize why they need to back US entrepreneurs.
Right.
Because they see China having at least a public sector or government-led advantage in establishing that field.
Interesting. I just wonder when the returns start coming in, if that becomes different. Hey, Ed, really great stuff. Appreciate it. Bloomberg's Ed Ludlow joining us there. And you can catch Ed and Caroline Hyde on Bloomberg Technology coming in around 90 minutes time. We're about an hour into a U.S. trading session. Words are hard. And literally nothing's happening. Got the S&P flat, Dow flat, NASDAQ 100 flat. Abigail's tracking some of the moves underneath that, though. Abigail?
Yeah, tiny mixed moves here for these major indexes, Alex. You have that S&P 500 up slightly. You have the NASDAQ 100 down slightly. But take a look at some of these other more specialized indexes. You have the Russell 2000 up 1.6%. Now, last Friday, Romaine yesterday was informing me that there was the widest spread for the Russell 2000 to the S&P 500 in quite some time. In other words, outperformance. That is the case again today. We have this small cap index outperforming by 1.5%. Not a small thing. You also have banks higher up 2.6%. Clearly, the two are linked with a lot of banks being on the smaller cap side, especially after the bank turmoil of March. So let's put it together because Alon Rosen of Oppenheimer and Options Insight yesterday was telling me that he and Oppenheimer really sees an opportunity now in small cap. So this is a year-to-date chart. Up top, we have the NASDAQ 100, big cap, QQQs, really outperforming up 33% basically on the year. The S&P 500 not so shabby, up 11%. Now the Russell 2000 had been slightly negative a couple weeks ago. Now it's up 4.3%, but Alon was telling me that they think that we're going to start to see this rotation, that this year's rally is going to broaden out to beyond just these big tech names, that it could go into a lot of other sectors, which could give a lift to the Russell 2000. We're certainly seeing that today. As for some of the other cross assets that we might take a look at, the VIX 14 handle, even with the S&P 500 barely making up its mind on what it wants to do. So complacency there. Yields, we have bonds lower, yields higher, supporting the idea that maybe we're going to see the major indexes follow those specialty indexes. Crude, on the other hand, that risk assets down after a nice little run. And then Bitcoin, yesterday, Tom, it had been down 6-7%, I believe. Now it's rebounding just a little bit, up 1%, despite the SEC now suing Coinbase in addition to Binance.
Yeah, holding above 25,000, at least for now, Bitcoin. Abigail Doolittle, thank you very much for running us through, of course, all the market moves. Now, the US Securities Exchange Commission does go after crypto, as Abby was just saying. It just sued Coinbase for breaking securities rules. That's a day after it went after Binance. Bloomberg Wall Street Week anchor David Weston spoke with SEC Chair Gary Gensler about the lawsuits.
This is actually a straightforward securities case, but it's in the context of crypto. And let me just say, crypto tokens, the investing public needs that same disclosure, full, fair, and truthful disclosure, we say. And in the crypto space, it's largely built on a business model that's non-compliant with the securities laws. People are commingling all of the customer funds. It would be as if the New York Stock Exchange is also operating a hedge fund and trading against their customers, or add to it that they don't have proper controls to avoid manipulative trading on the platform by their sister. So here, Binance had a sister organization controlled by Mr. Zhao called Sigma Chain. So absolutely, it's straightforward. Protect the public through the securities law, build confidence and trust, but it's in the context of crypto.
You have said elsewhere that there are certain custody rules here that registered financial advisors have to pay attention to when it's something like Binance. Are you looking at some of those financial advisors for possible violations?
Look, I'm not going to get into any one investigation or case that we haven't yet brought, but I would say this to all of those investment advisors out there that may be interested in trading in crypto: your client funds, under an existing 2009 rule, have to be proper qualified custodians, and that's not what you have on Binance. Make no mistake. In fact, as we alleged, your funds in custody at Binance, you don't even know really who's where it is. You know that Mr. Zhao ultimately is controlling it, but it may have actually moved it to a sister organization. There's another one that we allege, Merit Peak, that billions of dollars of funds were moving to.
So that raises another question about the extent to which what you're seeing with respect to Binance and Mr. Zhao may well apply to other companies doing similar things. Do you have similar custody problems with other people dealing with crypto? Obviously, this is the largest exchange there is, but other similar entities.
I would say this: it may be the largest exchange because we allege that they had corrupted their trading volumes by a lack of risk controls about their affiliates, Sigma Chain and Wash Trading. But moving on to your question, there are challenges of custody throughout this space. And secondly, there's a business model that bundles and commingles functions that we don't see, nor would we allow elsewhere in finance. And so there's parallels here to the FTX fraud and manipulation that we saw, and we allege against Sam Bankman-Fried, where he had a sister organization, Alameda, and the special arrangements with that trading platform, FTX. You see platform after platform that the entrepreneurs behind the platform also are trying to build wealth for themselves and their investors through sister organizations, hedge funds, trading against the customers, or even as it relates to where there might not be a sister organization, that they're dealing against their customers.
Given what you just said, that you've seen this in the business models, not just of Binance, but elsewhere, what does this mean for the crypto industry more broadly?
Look, I think the crypto industry more broadly, if it's going to have any success going forward, has to come into compliance with basic public policy about disclosure, about avoiding conflicts, about properly segregating customer funds, and guarding against fraud and manipulation. Without that, this whole area stands a chance of collapsing like a house of cards. And look, there's legitimate questions out there. What even might be the value of the individual tokens? We're merit neutral, but we're not public policy neutral. The business models need to adjust to come into compliance, and that may be hard work, but it's going to promote trust in this field, which otherwise it's just, as I've often said, it's a Wild West and a bunch of casino operators.
In your complaint, you name specifically some tokens that you say are unregistered securities. I assume that that's not a complete list. Are you going to come up with a complete list? Are you going to do this by enforcement action, or might there be a regulatory statement? These are all of the cryptos that we think are securities that are subject to regulation.
Number one, we've already had those regulatory statements, and they're by Congress and the U.S. Supreme Court. And an investment contract is one of 30 terms in the definition of securities. And as Thurgood Marshall, a famous justice of the Supreme Court, said, Congress painted with a broad brush. Secondly, yes, we've brought enforcement actions, well over 100, and we've been clear, whether it's settled or litigated actions, and courts have seen us lay out the facts to the public that most of these come under the securities laws. And it comes down to this, David. The public is relying on a group of entrepreneurs in the middle, and they're looking at the Twitter feeds, they're looking at the websites, and these are the same entrepreneurs that are hiring lawyers to try to thwart the investor protection we're talking about. So I think that the rules and the regulations are already clear.
That was Gary Gensler, SEC chair, speaking with Bloomberg Wall Street Week anchor David Weston, really pushing back on the fact that this was the SEC in any way falling asleep, saying that the rules were clear, everyone else did the bad stuff. But the House of Cards comment, Tom, I thought was really quite interesting. Everything's going to collapse like a house of cards. Yikes.
I mean, that was strong. And then of course, he questioned the value of these coins. He said, look, it's not for us to make a judgment. But they're clearly very concerned about the commingling, as he said, between the markets and the hedge fund components of this. I was speaking to someone at Binance earlier who said, but the fact that, Coinbase, talking about one of their competitors, they were listed, the IPO, of course, back in 2021. The regulators signed off on that. So what happened there was a response from this particular person. Everyone's going to take a view on this. But to say that regulators in the US are not taking this seriously, that's hard to call at this point. It seems that they're taking it very seriously.
Yeah, but that goes to Gary Gensler's point. Like, rules are clear. We did our job versus the pushback from the Binance and Coinbase, which is like, well, they were there. We tried to do what we were supposed to do and follow the rules. So obviously just the beginning of this, as Gary Gensler made very clear. All right, coming up, you got European natural gas futures are down today, but they were up 20% yesterday. You also had an ECB governor talking about how the second round effects of energy inflation are going to be coming to Europe. So we're going to talk to someone with an inside scoop on this. Colin Parfit, a Chevron Vice President of Midstream, will be joining us next for more. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Simone Foxman. Jamie Dimon will be on Capitol Hill today. Bloomberg's learned the JP Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. Closed-door lunch takes place as Dimon's been urged to enter the 2024 presidential race despite his protests that he does not plan to run. Prince Harry is in a London courtroom today to testify against a tabloid publisher he accuses of phone hacking and other unlawful snooping. Harry claims the publisher of the Daily Mirror used unlawful techniques to get scoops, which the company denies. Harry is the first senior British royal since the 19th century to face questioning in a court. And higher energy costs are reverberating through Europe's economies and are keeping inflation high. That today from European Central Bank Governing Council member Klaus Knot. The Dutch Central Bank governor spoke in Luxembourg today, a week before the ECB is widely anticipated to raise interest rates further before another projected increase in July. Global news, 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman, and this is Bloomberg. Alex.
All right, Simone, thanks very much. Let's stay with that idea and with energy. So European gas prices popped like 24% on Monday. Is it a fundamental thing? Was it short covering? It's hard to tell, but it does go to show that potentially the energy crisis is far from over. We all know the world's going to need more natural gas, at least in the short term. So now we're joined by Colin Parfit. He's Chevron Vice President for Midstream, which basically all encompasses LNG trading, gas trading, oil trading, sending stuff around the world. It's all of that good stuff. So Colin, thank you for joining us. It's great to see you.
Alex, thanks for inviting me on today.
So what helped Europe get through the winter was that China didn't really need the gas. And I'm wondering from where you sit, where LNG is being divvied up. Like, how competitive is China versus Europe right now for cargoes?
Yeah, so, I mean, I'll kind of try and answer that in a couple of ways.
Yeah.
Europe, China wasn't pulling gas, but Europe also had a mild winter.
Yes, true.
Temperature was low, it had a lot of wind, and that helps with its wind power. But fundamentally, Europe's short of energy and it's short of gas. So since the Russia-Ukraine crisis started, Europe used to take 40% of its gas from Russia. That flow's now stopped. So essentially that flow has to come from somewhere else. And so what we've really seen in the last year is more LNG, so liquefied natural gas, come from the United States and come from the Middle East and supply into Europe. So essentially you've seen a redistribution of trade, but fundamentally the world has less gas because that Russian gas is not going anywhere.
Yeah, and that creates issues. Speaking of China for a moment, Bloomberg has learned through a scoop from Anne-Marie Hordern that Antony Blinken, Secretary of State, will be traveling to Beijing for talks in the coming weeks. Remember, this comes as Sequoia Capital is going to divide up its business from China, India, and the U.S. as tensions still kind of bubble up despite any handshakes that we've seen on TV. So Anne-Marie Hordern breaking that Secretary of State Antony Blinken will be traveling to Beijing for talks in coming weeks. We'll have more for you in just a moment. Colin, so to that point, are you seeing Europe commit to longer-term contracts? Because part of the issue also has become is that Europe doesn't want to sign a 20-year contract because they're like, hey, I only want this for like 7 or 10 years. What are you seeing on the ground?
So, I mean, the short answer is yes, you are seeing lengthening, but maybe look, if I just elevate a little bit, Alex, so, what does the world need? I mean, we think about the world wanting affordable, reliable, and ever cleaner energy, and we think it needs all of those three things together. So one of the things that gas really plays into that, it's a reliable source of energy, and it's one that has, some of the lowest emissions of kind of the fossil fuels. So we think that plays. Europe's got to balance all these three things. And so what we observed is early in the crisis, there was a bit of, I'll call it, dichotomy in people not necessarily wanting to commit for a long period of time